Hi, this is John Giordani, the Chief Investment Officer at Planning Solutions Group. With 3 quarters of 2017 in the books, let's jump in and take a look at what so far has been a very pleasant year for investors. Diversified investors have been handsomely rewarded this year. It's hard to turn on the news without hearing about U.S. stocks at record high prices. And not to be outdone, international stocks for the first time in years are outperforming those here at home. Bonds are also outpacing inflation this year. Bottom line, it's been a good time to be in the markets. This is a story driven by improving earnings and improving economic growth around the world. The short version of the book report is a resurgence of earnings growth, not only here in the U.S. but overseas as well. Shown here is earnings growth for last year and estimates for this year, for the U.S. in blue, international markets in red, and emerging markets in green. This story actually begins well before 2016, when most of the world was in an earnings recession during various points going back as far as 2012. Recall, U.S. corporate earnings fell for over 6 quarters. The rest of the world was much worse, and we were very worried about this trend. However, earnings began to stabilize and recover last year, but overall did grow very little. Notice the acceleration this year. U.S. corporate earnings should grow over 10% this year, and international and emerging market corporate earnings should grow much higher than this. Corporate earnings and stock prices are correlated, and as investors have become more confident about the earnings picture, prices have followed. Let's take a look at the economy. Shown here is manufacturing data for the United States. It shows a strengthening U.S. economy. Don't worry about all of the busy data in the chart, but just focus on the last 3 columns. For direction, as we head down the column, we see the word growing a lot. Then as we move over to rate of change, we see the word faster. And then lastly, in the trend column, we see how many months the current trend has been occurring. In general, over a year or more. This continues to be a very healthy U.S. economy, one that is growing, not going gangbusters, but headed up and to the right. International economies are also growing. Pretty much every major economy in the world is growing, and we haven't seen an environment like this for a very long time. Inflation is also low. Here's a 50-year chart of year-over-year inflation growth. The most recent reading on CPI at the end of August shows inflation at 1.9%, which is well below the 50-year average rate of 4.1%. This is important, as if inflation is high, it eats up a good chunk of those corporate earnings growth that I talked about earlier. A low inflation environment is much preferred as an investor. Investors may also get help from D.C. in the form of lower taxes. The new administration laid out more details on its plan recently. Overall, it is pretty aggressive, but let's look at the proposed corporate tax cut part of the plan. We spent a lot of time discussing this earlier in the year. To summarize, U.S. corporate tax rates are near the highest in the world, and tax relief would filter right to the bottom line. Shown at the right from Goldman Sachs Asset Management highlights that the proposed cuts could lift the largest U.S. company's earnings by as much as $10 per share, or 8%. Now we're talking somewhere around $20 billion per year. This could serve as another catalyst for U.S. stock prices. Yes, I'm optimistic by this development, but it is in the hands of lawmakers. With the amount of dysfunction with our politicians, who knows where this ends up. In addition, the tax proposals as a whole carry a very large sticker price. Over time, I'm not sure how the U.S. pays for this without accepting much larger deficits, something several members of Congress are opposed to. This backdrop has led to a very low amount of volatility in the stock market. Here is a measure called the VIX, which measures U.S. stock market volatility. When investors are fearful, like in 2008, they purchase large amounts of insurance, which drives volatility higher. Right now, investors are saying there is no need for this insurance, as volatility by this measure is at all-time lows. Now, some other facts for your cocktail party banter. We haven't had a 3% pullback in U.S. stocks since the election. Only one other period has lasted longer. And if the year were to end today, the 2.8% correction the stock market has had this year would also be the second lowest in history. Think about it. we're experiencing one of the calmest markets in 30 years with probably the most controversial of presidents. This is another reason to not let political decisions interfere with your portfolio. We have discussed this at length in previous communications about how politics and investing don't mix. Some professionals are calling this a Goldilocks environment. The economy is not too hot nor too cold, but just right. The belief is that the set of circumstances exists to keep the economy chugging along, and risks of recession are several years out. With not a lot of worries on investors' minds, low inflation, and record U.S. stock prices, I've also seen nirvana thrown around. So, what is there to be negative about? Perhaps Bank of America Merrill Lynch summed it up best. The best reason to be bearish is there is no reason to be bearish. However, let's take a look at a couple of items that could derail these good times. First of all, how about what's going on with North Korea? If this geopolitical risk escalates, where does that leave us? LPL and FactSet looked at 21 past military conflicts going back to World War I and how the U.S. stock market responded. As one would expect, the initial reaction was lower, on average by 4%. The range was wide though, slightly positive in some cases to double-digit sell-offs in others. One thing we do know is that markets have always recovered. In fact, in over 80% of the cases, 6 months later, stock markets had rebounded and on average were up nearly 10%. Looking out 12 months later, markets were materially higher on average. Hopefully our leaders solve the North Korea issues peacefully. Now this is a rehash from last quarter, but I still think it's very important. Valuations are high for most asset classes. That means a lot of the good news that I've talked about is likely reflected in stock prices, especially here in the United States. This table highlights the valuations for both U.S. and international stock markets. It's broken down by percentile. Moving along to the right, the more expensive the asset class is to historical valuations during the past 20 years. U.S. stocks are now in the most expensive quartile. This means that on average, over 75% of the time, they have been less expensive than they are now. International stocks in Europe, Japan, and emerging markets, or EM, are cheaper than U.S. stocks on a relative basis. Now, if you like to buy items on sale, this may be another reason that international stocks may outperform going forward as valuations play catch-up to those we have here at home. Now, this doesn't mean it's time to exit U.S. stocks. Valuations are not a good predictor of short-term price movements. However, they are a very good predictor of future returns 7 to 10 years out. Historically, when U.S. stocks have been this expensive, returns have been below average. The message here is simply to lower your return expectations going forward. Now, some other risks include U.S. policy failure. So far, not one major policy initiative has been enacted by our politicians in D.C. since the new president was elected. Investors want to see fiscal stimulus, including tax reform or infrastructure. In previous updates, we spent a lot of time talking about central banks. The Fed will likely raise rates again here in December, and this month will begin shrinking its balance sheet. They are very slowly taking away the punch bowl. Now, a too fast approach could send us into a recession, which would not be good for markets. So where does that leave us? We are more cautious than several years ago. Given where we are in the cycle and the run that U.S. stocks have had, having a diversified portfolio is important. Owning blue chip type companies that have higher quality balance sheets make more sense than speculative companies. Playing a little more defense also doesn't hurt. Having defensive assets gives you a piggy bank to take advantage as opportunities become present in the market. And also on the bond side, emphasize flexibility and diligence to protect against interest rate risk and credit risk. This wraps up our current market update. If you have any questions, please contact us. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update early next year. Thank you.